The decision that no one was supposed to notice. It happened without drama, without headlines, without any sign that history was being nudged off course. A single decision, quietly approved and quickly forgotten, would go on to reshape markets in ways almost no one traced back to its source. This story matters now because the forces that move markets most powerfully are rarely the ones we argue about in public. They are the small adjustments made behind closed doors, the technical choices treated as routine, the moments dismissed as procedural. To understand how today's markets became so sensitive, so fast, so fragile, we need to go back to a decision no one thought mattered. It began inside a regulatory committee, meeting few outside the industry even knew existed. The agenda was dense, technical, and deliberately uncontroversial. The goal was efficiency, reduce friction, modernize outdated processes. The change was framed as maintenance, not reform, a minor tweak to how liquidity was measured and reported. On paper, the logic was airtight. Markets had evolved. Technology had accelerated. Old safeguards were seen as blunt instruments slowing progress. The adjustment promised smoother trading, tighter spreads, and more capital efficiency. No politician debated it. No media outlet questioned it. It passed unanimously. The early reveal came not through prices, but through behavior. Large institutions adjusted quietly. Balance sheets expanded slightly. Trading desks found they could carry more exposure with the same reported risk. Nothing reckless, nothing obvious. Just a subtle loosening that rewarded those who moved first. Over the following months, strategies adapted, models recalibrated, assumptions shifted. The market didn't change overnight, but its posture did. It leaned forward, confident, comfortable, unaware that the ground beneath it was now thinner than before. Almost no one noticed. And that was the problem, because when a system adapts to a quiet decision, reversing becomes far more dangerous than making it. The decision wasn't meant to be historic, but history was already bending around it. As the adjustment settled into the system, its effects compounded in ways no single model captured. Institutions that embraced the new framework early gained an edge. Capital moved more freely. Returns improved. Efficiency was celebrated. Those who hesitated were forced to follow or fall behind. The reveal deepened as leverage quietly increased, not in dramatic leaps, but in careful increments that passed every compliance check. Risk metrics stayed within limits. Stress tests still passed. On dashboards, everything looked under control. But the controls were now calibrated to a world that no longer existed. The early conflict emerged when market behavior began to change. Price moves felt sharper. Liquidity seemed abundant until it wasn't. Small shocks traveled further, faster. Traders adapted instinctively, blaming speed, blaming sentiment, blaming anything visible. Few questioned the foundation itself. Behind the scenes, risk teams noticed inconsistencies. Models required more frequent adjustments. Correlations behaved strangely under stress. Scenarios that once seemed extreme now appeared plausible. But raising concerns was difficult. The data didn't point to failure. It pointed to success, higher efficiency, better utilization, smoother flows. The system was doing exactly what it had been designed to do. That was the danger. As strategies converged around the same assumptions, diversity faded. Positions clustered. Liquidity providers relied on similar signals. When confidence was high, the market felt invincible. When confidence wavered, reactions synchronized. The adjustment had not removed risk. It had hidden it. And hidden risk has a way of resurfacing all at once. By the time the first real stress arrived, the market had already been reshaped, not by greed, not by recklessness, but by a decision no one was supposed to notice, now woven into every trade, every model, every expectation. The question was no longer whether the decision mattered. It was when its consequences would become impossible to ignore. The consequences surfaced gradually, then all at once. A modest market shock, nothing historic, nothing alarming, tested the system's new posture. In the past, it would have been absorbed quietly. This time, it rippled outward, sharper and faster than expected. The conflict intensified as liquidity behaved unpredictably. It surged when confidence held, then vanished the moment uncertainty appeared. Traders felt the shift immediately. Orders that once filled smoothly now slipped. Spreads widened in sudden bursts. What looked like efficiency now felt like fragility, wearing a polished mask. Institutions reacted defensively. Risk limits were tightened. Positions were trimmed. But each adjustment fed into the same loop. Selling pressure created signals. Signals triggered withdrawals. Withdrawals amplified price moves. The market wasn't panicking. It was synchronizing. Inside risk departments, the realization set in with quiet dread. The decision that had loosened constraints had also aligned behavior. Too many systems responded the same way, at the same time. The safeguards designed to protect stability now accelerated instability when stress appeared. The buildup reached its peak when a routine funding operation stalled. Not failed, stalled. Just long enough to expose how thin buffers had become. Overnight rates twitched upward. Counterparties hesitated. That hesitation spread faster than any data release ever could. Suddenly, what felt like a series of isolated reactions snapped into a single narrative. The market wasn't overreacting. It was revealing what had been accumulating beneath the surface for years. The decision had worked, until it didn't. Traders looked for villains. Commentators searched for culprits. But there was no scandal, no rogue actor, no reckless bet gone wrong. The stress came from alignment, not excess. The system had been optimized for calm, and calm had quietly trained how to break. The decision no one noticed was no longer invisible. It was everywhere. The climax arrived in the form of recognition rather than collapse. Markets didn't crash. They froze, just enough to force everyone to see what had been hidden in plain sight. Liquidity didn't disappear entirely. It hesitated, and that hesitation revealed how little margin for error remained. Authorities stepped in quietly. Facilities were adjusted. Backstops widened. Language softened. Nothing dramatic was announced, but insiders understood the signal immediately. The system needed support, not because it failed, but because it had been stretched too thin to absorb stress on its own. The resolution unfolded through subtle reversal. Risk was repriced. Buffers were rebuilt. Constraints returned under new names. The same institutions that once praised efficiency rediscovered the value of slack, not as waste, but as insurance. In hindsight, the decision wasn't reckless. It was incomplete. It assumed stability would persist long enough for efficiency to matter more than resilience. And for a time, it did, until it didn't. Modern relevance could not be clearer. Today's markets are shaped less by visible events than by invisible choices embedded deep within systems. Small technical decisions can alter behavior across trillions of dollars. And when those choices go unquestioned, their consequences compound quietly. The lesson wasn't about blame. It was about awareness. Because the most powerful forces in finance are rarely announced. They are approved in silence, adopted in comfort, and only understood when the system pauses just long enough to reveal what it has become. Sometimes the smallest shift in perspective becomes the beginning of a new future. The decision